You have finally made the agonizing decision to sell your home. After months of sleepless nights, staring at the ceiling, calculating your dwindling savings, and worrying about the rising cost of living, you have accepted the reality that you can no longer afford your mortgage. You have watched our previous videos on panic selling. You have seen the market softening, and you have decided to cut your losses. You want to do the responsible thing. You want to sell the asset, pay off the bank, and walk away with whatever equity you have left to start over. You hire a real estate agent, you stage the home, you endure the stress of open houses, and finally, miraculously, you find a buyer. The offer is lower than you hoped, but it is enough to cover the mortgage balance. You feel a wave of relief wash over you. The nightmare is ending. Then you are going to be free. But then, just days before the closing, your lawyer calls you. Their voice is hesitant, heavy with bad news. They tell you they have received the payout statement from your bank. You assume it will be the remaining balance of your loan, plus a small administrative discharge fee, maybe $300 or $400. But the number the lawyer reads to you is not $300. It is $50,000. You drop the phone. You can't breathe. That is the entire amount of equity you had left. That is the money you needed for a rental deposit, for moving trucks, for your survival. The bank is not just taking their loan back. They are charging you a penalty so massive it wipes you out completely. You are not free. You are in a mortgage prison. Welcome back to Canada Property Watch, where we expose the hidden mechanisms of the financial system that are designed to extract wealth from the middle class at every stage of the real estate cycle. We have shown you how they trap you when you buy, how they squeeze you when you renew, and today we are going to show you how they gut you when you try to leave. Today, we are deep diving into the penalty trap, specifically the interest rate differential, or IRD. This is the single most misunderstood and devastating clause in Canadian mortgage contracts. And right now, as thousands of homeowners rush to sell their homes to escape crushing debt, this clause is being weaponized to generate billions of dollars in pure profit for the major financial institutions. To understand why this is happening now, in 2026, we have to look at the unique economic environment we are living in. For the past few years, interest rates have been volatile. Many Canadians locked in 5-year fixed-rate mortgages during the peak of the rate hike cycle because they were terrified rates would go even higher. They signed contracts at 5%, 5.5%, or even 6%, but now, as the economy slows down and bond yields begin to drop, the current market rates for new mortgages are starting to inch lower. This sounds like good news for the economy, but for you, the person holding that high interest contract, it is a disaster waiting to happen. When you sign a fixed rate mortgage, you are essentially entering a contract where you promise to pay the bank a specific amount of interest for a specific period, usually 5 years. The bank takes that promise and banks on it. They count that future interest as an asset. When you try to break that contract early by selling your house, the bank looks at the interest rate you promised to pay and compares it to the interest rate they can lend that money out at today. If today's rate is lower than your contract rate, the bank is losing money. They cannot lend that money to a new person and make the same profit they were making off you. So, who pays for that lost profit? You do. This is the interest rate differential. The bank calculates the difference between your rate and the current rate for the remainder of your term, and they charge you that entire amount in one lump sum on the day you sell. But here is where the penalty trap turns from a fair business practice into a predatory extraction scheme. The banks do not just calculate the simple difference. When they use a convoluted formula based on their posted rates. The posted rate is an artificially high interest rate that almost nobody actually pays. When you walked into the bank 3 years ago, the mortgage specialist probably told you, don't worry about the posted rate of 6%. We are giving you a special discount rate of 4% because you are a valued client. You felt special. You felt like you got a deal. But that discount is now the weapon they use against you. When calculating your penalty, the bank often takes the current posted rate and subtracts your original discount to find a comparison rate. Because the posted rates are kept artificially high, this comparison rate ends up being artificially low. This widens the gap between your rate and the comparison rate. And in the math of the interest rate differential, The wider the gap, the bigger the penalty. This little accounting trick can turn a $10,000 penalty into a $30,000, $40,000, or even $50,000 penalty. We have seen payout statements from major Canadian banks where the penalty to break the mortgage was actually higher than the down payment the homeowner originally put on the property. This is the silent killer of the panic selling wave. We are seeing thousands of listings hit the market, sitting there for months and then suddenly being terminated. Why? Because the sellers did the math. They realized that after paying the real estate commissions, the land transfer taxes, the legal fees, and this massive bank penalty, they would actually have to bring a check to the closing table. They cannot afford to sell their own house. They are trapped in the property, forced to keep making payments they cannot afford, slowly bleeding out financially because the cost of exit is simply too high. This is what we call mortgage prison. You are locked in a cell made of your own debt, and the bank holds the key, demanding a ransom you cannot pay. It is crucial to understand that this penalty applies specifically to fixed-rate mortgages. If you have a variable rate mortgage, the penalty is usually much softer, typically just 3 months of interest. This is why mortgage brokers often advise clients who are planning to sell soon to stay variable. But think back to 2023 and 2024. What was everyone being told to do? Everyone was told to lock in. The narrative from the media, the banks, and the brokers was that rates were going to the moon and you had to lock in a fixed rate to survive. Millions of Canadians followed that advice. They converted their variable mortgages to fixed mortgages to sleep better at night. Now, those same people are the ones facing the $50,000 penalties. They locked themselves into the trap right before they needed to escape. But the interest rate differential is not the only way the banks are locking the doors. There is another, even more insidious clause that is burying homeowners, the Bona Fide Sale clause. Over the last few years, to compete with low-rate online lenders, major banks and monoline lenders introduced low-rate basic or value mortgages. These products offered a slightly lower interest rate, maybe 10 or 15 basis points cheaper than the standard product. To a cash-strapped buyer, saving $20 a month sounded great, but buried in the fine print of these contracts was a bona fide sale restriction. This clause dictates that you literally cannot break the mortgage contract for any reason unless you sell the property to an arm's-length third party. You cannot refinance. You cannot switch banks to get a better rate. You cannot even pay the penalty to leave. You are legally handcuffed to that lender until the day the term expires. And if you do sell, the penalty calculation on these value products is often even more punitive, calculated using an even more aggressive formula that ensures the lender recoups every penny of the discount they gave you. We are seeing sellers who accept an offer on their home and only to find out that their lender rejects the payout because they don't consider the sale bona fide enough, or because the penalty is so high it consumes all the equity, making the transaction insolvent. Now, let's talk about the portability myth. Many of you are screaming at your screen right now, saying, "But wait, my broker told me my mortgage is portable. I can just move it to the new house." This is the lie that keeps people calm until it is too late. Yes, theoretically, most fixed-rate mortgages are portable. You can take your existing loan with its existing rate and term and transfer it to a new property. This avoids the penalty. It sounds perfect for someone who is downsizing to a cheaper home to save money, but here's the catch that nobody explains until you are sitting in the bank manager's office. To port a mortgage, then you have to re-qualify for the loan. The bank does not just transfer the debt, they underwrite you all over again. And they underwrite you based on today's stress test rules and your current financial situation. If you are selling your home because you are in financial distress, if your income has dropped, if you have taken on more credit card debt to survive the inflation crisis, or if your credit score has taken a hit because you missed a utility payment, you will fail the requalification. The bank will look at your application to port the mortgage and say, "We are sorry, you no longer meet our lending criteria." They deny the port, and because they deny the port, you are forced to break the old mortgage and pay the full $50,000 penalty. It is a catch-22 designed to destroy you. Then you are downsizing because you can't afford the debt. But because you can't afford the debt, They won't let you keep the cheap mortgage, forcing you to pay a penalty that ensures you can't afford the new home either. The portability clause is a privilege, not a right, and the banks can revoke it exactly when you need it most. We also need to address the cashback clawback. Remember when you bought your home and the bank offered you $3,000 or $5,000 in cash back to cover your legal fees or buy new furniture? It felt like free money. It wasn't. It was a loan disguised as a gift. If you break your mortgage before the 5-year term is up, the bank demands that you repay that cash back, usually on a prorated basis. But they add this to the penalty pile. So now you have the interest rate differential, the discharge fee, and the clawback of the cash you spent on a sofa 3 years ago. It all adds up to a payout statement that makes grown men cry in lawyers' offices. This trap is not limited to the big banks. If you were forced to go to a B lender or a private lender because you couldn't qualify with a major bank, the penalty structure is different, but often just as brutal. Private lenders typically charge lender fees and broker fees on the way out. A standard lender fee might be 1 or 2% of the mortgage balance. If you have an $800,000 mortgage, a 2% exit fee is $16,000. That is on top of the 3 months interest penalty. And unlike the big banks, private lenders are ruthless about enforcement. They will issue a notice of sale the moment the mortgage goes into default. And their legal fees, which you are responsible for, start clocking at hundreds of dollars an hour. So, what happens to the money? Where does this $50,000 penalty go? It doesn't disappear into the ether. It goes directly to the bank's bottom line. In a year where mortgage origination volume is down because nobody is buying houses, banks are relying on non-interest income to prop up their earnings reports. Non-interest income is a fancy banker term for fees, late fees, overdraft fees, and yes, mortgage prepayment penalties. The misery of the Canadian homeowner is acting as a hedge for the bank's shareholders. When you lose, they win. They have hedged their risk against your life. This reality is creating a secondary crisis in the real estate market, the inventory stagnation. We are seeing inventory pile up, but sales are low. Part of this is lack of buyers, but a huge part is the seller's strike caused by the penalty trap. Sellers are doing the math and realizing they cannot sell at the current market prices because the bank penalty eats the margin they need to clear the title. So they pull the listing. They decide to tough it out. They borrow from credit cards to pay the mortgage. They stop buying groceries. They let the house fall into disrepair. They become zombie homeowners, living in a property they effectively no longer own, working solely to service the debt and the future penalty. This stagnation delays the inevitable market correction. It keeps prices artificially propped up because supply is being constrained by the penalty barrier. But eventually the dam breaks. Eventually the homeowner runs out of credit. Then they miss payments. The bank initiates a power of sale. And here is the ultimate irony. When the bank forecloses on your home and sells it under power of sale, they do not charge themselves the penalty. The penalty evaporates because they are the ones breaking the contract to sell the asset, but they will still add it to the debt you owe them, and they will pursue you for the deficiency judgment after the house is sold. They sell your house for less than you owed, they add the $50,000 penalty to the shortfall, and they garnish your wages for the next 10 years to pay for a contract that they terminated. This is the system working exactly as it was designed. It is designed to prioritize the sanctity of the contract over the survival of the human being. So, how do you defend yourself against the penalty trap? And if you are considering selling your home in 2026, you must take these steps immediately. First, do not put a for sale sign on your lawn until you have ordered a payout statement from your lender. Do not guess what the penalty is. Do not use an online calculator. Call the bank and ask for the exact discharge figure in writing, calculated for the date you plan to close. You need to see the real number. If the person on the phone gives you a vague answer, demand a supervisor. You have a right to know the cost of your freedom. Second, check if you have a Bona Fide Sale clause. Pull out your original mortgage commitment, the thick stack of papers you signed and threw in a drawer. Look for terms like low rate basic, restricted, or no refinance. If you have this clause, you have zero leverage. You must sell to leave. And knowing this will stop you from wasting time trying to refinance with another lender, which would trigger a credit check and lower your score for nothing. Third, investigate the blend and extend strategy. If the penalty is too high to stomach, but you need to move, ask your bank if they will allow you to blend your current rate with the new current rate and extend the term. This can sometimes allow you to avoid the penalty by committing to the bank for another 3 or 5 years. It is not ideal. You are still in debt, but it might allow you to move to a cheaper home without writing a $50,000 check. Fourth, if you are planning to buy a new home, fight for the port. If the bank denies your portability request, do not take no for an answer. Escalate the file. Show them that by moving to a cheaper home, your debt servicing ratios are actually improving, even if your income is the same. Sometimes, a human underwriter can override the computer's rejection if you make a compelling case. But you have to be aggressive. You have to advocate for yourself because the system is set to default to deny. Finally, consider the timing. The interest rate differential is based on the time remaining in your term. Every month that passes, the penalty potentially shrinks, though not always depending on rate movements. Sometimes, waiting 3 months can save you $5,000. Ask the bank to run the penalty calculation for a date 3 months or 6 months in the future. See if there is a cliff where the penalty drops significantly. But we are entering a phase of the housing crisis where the dangers are no longer just about market prices dropping. The dangers are in the fine print. The dangers are in the exit doors being locked. The penalty trap is catching thousands of responsible, hardworking Canadians who are just trying to do the right thing by deleveraging. They are trying to fix their financial mistakes, but the bank is charging them a fortune for the privilege of fixing it. Do not let the bank blindside you on closing day. We have heard too many horror stories of families who had their moving trucks packed, only to realize on the final day that they didn't have enough money to close the deal because of the penalty. The deal collapses. The buyer sues them. The bank sues them. It is a total financial apocalypse. Get the numbers. Read the contract. And understand the trap. In our next video, we are going to look at what happens when you survive the penalty, you sell the house, and you think you are finally safe, only to find out that the Canada Revenue Agency is waiting for you with a new weapon. We are going to expose the capital gains trap and how the government's new inclusion rate is wiping out the retirement funds of seniors who sell their secondary properties to pay for their care. The government wants their cut, and they are taking it from your equity. Subscribe to Canada Property Watch. We are digging through the payout statements, we are analyzing the penalty algorithms, and we are bringing you the truth that the banks don't want you to know. The housing market is a minefield, and the only way to get through it is to know exactly where the mines are buried. Stay vigilant. Protect your equity. And never assume you can just walk away until you see the price of the exit. To fully grasp the magnitude of the penalty trap, we need to look at the psychology of the posted rate. Why do banks have a posted rate that is 2% higher than the real rate? They will tell you it's for marketing or a benchmark. That is a lie. The primary purpose of the posted rate is to inflate the interest rate differential penalty. It is a legal fiction designed to maximize damages. When you sign a mortgage that offers you a deep discount off the posted rate, you are effectively signing a document that says, if I leave early, you can use a fake higher interest rate to calculate how much I owe you. It is a trapwire laid on day one, waiting for you to trip on it 3 years later. Let's look at a concrete example. Don't imagine John and Sarah. They bought a home in 2023. They took a 5-year fixed mortgage at 5.5%. They owe $600,000. They need to sell today because one of them lost their job. They have 2 years left on the term. The bank's current rate for a 2-year term is 4.5%. The difference is 1%. Simple math says 1% of $600,000 is $6,000 per year for 2 years, so the penalty should be $12,000. That hurts, but it's manageable. But wait. The bank doesn't use the 4.5% market rate. They look at the discount John and Sarah got. They got a 2% discount off the posted rate back in 2023. So the bank takes the current posted rate, applies that 2% discount, and comes up with a comparison rate of 2.5%. Now the gap isn't 1%. The gap is the difference between their contract rate of 5.5% and this new comparison rate of 2.5%. The gap is 3%. Suddenly, thus the penalty calculation is based on a 3% loss. That triples the penalty. Instead of $12,000, John and Sarah are hit with a $36,000 penalty, plus the discharge fee, plus the cashback clawback. They are staring at a bill for $40,000. This extra $28,000 didn't come from a real financial loss the bank suffered. It came from the posted rate gimmick. It is pure manufactured profit extracted from a distressed family. And it is perfectly legal because it was in the 40-page contract they signed electronically while rushing to beat a bidding war. This is why we call it a mortgage prison. John and Sarah might have $40,000 in equity in their home. If they sell, the penalty takes 100% of it. They walk away with nothing. They cannot put a deposit on a rental. They cannot pay for the movers. So they don't sell. They stay. And they stop paying the credit cards to pay the mortgage. They spiral deeper into debt. The bank's penalty structure effectively forces them to go bankrupt slowly, rather than letting them exit cleanly. And don't think you can escape this by waiting for the renewal. As we discussed in our previous report on the lump sum trap, when you get to renewal, the bank has other ways to get you. But the penalty trap is specifically designed for the panic sellers. It is the electric fence that keeps the sheep inside the pen to be sheared. We are also seeing a disturbing trend where banks are delaying the issuance of payout statements. Real estate lawyers are reporting that it is taking weeks to get these numbers from the lenders. Why? Because the back offices are overwhelmed, or perhaps because slowing down the exit process benefits the lender. And every day you are delayed is another day of interest you must pay. If the statement comes late and delays your closing, you breach your contract with the buyer. The buyer can sue you. The dominoes fall. You must request this statement the moment you even think about selling. The media often talks about the housing crash in terms of prices dropping, but the real crash is the liquidity crisis. It's the fact that you can't access your money. You can't access your equity. It is locked behind the penalty wall, the appraisal wall, and the qualification wall. The value of your house on paper might be $1 million, but if it costs you $50,000 to access it, is it really worth $1 million? Or is your equity an illusion? If you are a mortgage holder in Canada, you need to stop looking at your home as a piggy bank and start looking at it as a legal liability. Read your terms. Know your penalty exposure. The banks are not your partners. They are counterparties in a high-stakes financial contract, and right now, they are enforcing every single letter of that contract to protect themselves from the coming storm. Share this video with anyone you know who is talking about selling their home. Warn them about the $50,000 surprise waiting at the end of the transaction. Help them ask the right questions before they sign the listing agreement. Knowledge is the only shield we have left. We will see you in the next investigation, where we take on the CRA. Stay safe and watch your wallet. And watch.